$5.8 trillion. That is the amount of wealth that ultra-high net worth and high net worth families in the Asia-Pacific region will transfer between generations between 2023 and 2030, according to McKinsey. 5.8 trillion. To put that in perspective, it is larger than the entire GDP of Japan. And this intergenerational wealth transfer is happening alongside the fastest growth in millionaires and billionaires the world has ever seen. India added over 33,000 new millionaires in a single year. India's billionaire count rose to 308, third in the world behind China and the United States. And 165,000 millionaires are projected to physically relocate to new countries in 2026 alone, according to Henley & Partners. The question is not whether Asian wealth is growing. That is settled. The question is where this wealth goes, who manages it, and which financial hubs capture the flows. And that contest is being fought primarily between two cities.
Singapore and Hong Kong.
Singapore and Hong Kong. And the numbers show the competition is intense. The number of single-family offices across both cities has quadrupled since 2020 to approximately 4,000 combined. Hong Kong has grown from around 2,700 single-family offices in 2023 to close to 3,400 in 2026. Singapore crossed 2,000 single-family offices in early 2025, a 43% year-over-year increase from 2024. Each city is fighting for the same pool of wealth: mainland Chinese capital, Indian HNWI families, Indonesian tycoons, Southeast Asian tech founders. And the regulatory and tax frameworks they are offering reveal very different strategic bets.
Before we get into the competition, I want to understand the scale of Asian wealth creation, because these numbers are extraordinary.
The scale is genuinely unprecedented. Asia-Pacific is projected to account for half of all new global wealth creation by 2028, according to the Asset. India's high net worth population, defined as individuals with investable assets above $1 million, grew 5.6% in 2024, with their collective wealth rising 8.8%, outpacing both China and global peers. India now has approximately 378,800 high net worth individuals, up from around 345,000 in 2023. The Knight Frank Wealth Report showed that India is creating billionaires faster than both the US and China in proportional terms, a 12% growth rate from 2023 to 2024.
And the Chinese wealth picture?
China remains the world's second largest concentration of billionaire wealth at $1.34 trillion, behind only the United States. But the Chinese wealth story has a critical additional dimension: capital mobility. Following the regulatory crackdowns on tech companies, real estate sector instability, and broader concerns about the Chinese economic outlook, wealthy Chinese families have been diversifying capital internationally at an accelerating rate. This is the primary driver of the family office boom in both Singapore and Hong Kong: Chinese capital looking for a safe, well-regulated, tax-efficient home outside of mainland China.
How does the family office structure actually work?
A single-family office is essentially a private company that manages the wealth, investments, and affairs of one ultra-high net worth family. It is not a bank product. It is a dedicated entity that the family controls. The advantage is customization. The family can invest in anything, manage tax planning across jurisdictions, and handle estate planning for generational transfers. Both Singapore and Hong Kong have created specific regulatory frameworks and tax incentives to attract these entities. Singapore's Monetary Authority offers Section 13(0) and Section 13(u) tax exemption schemes. 13(0) requires minimum assets of approximately $15 million, and 13(u) requires about $37 million. Hong Kong offers its own tax incentive regime with even simpler operational structures.
So both cities are actively competing for family offices with tax breaks and regulatory sweeteners.
And the competition extends to investor visa programs, education systems, lifestyle amenities, and the broader ecosystem of private banks, legal firms, and investment advisors that serve wealthy families. It is a full-spectrum competition for capital and talent. Let's dig into what differentiates the two hubs.
Let's compare Singapore and Hong Kong. What are the strengths and weaknesses of each?
Singapore's core advantage is governance and predictability. MAS, the Monetary Authority of Singapore, provides clear, stable regulatory frameworks. The variable capital company structure, introduced specifically for fund management, is well designed for family offices. Singapore's political stability is a major draw. For Chinese families in particular, Singapore offers geographic proximity to China, a large Chinese-speaking population, cultural familiarity, and critically, political independence from Beijing. There is no extradition treaty with China, which matters for wealthy families concerned about asset security.
Hong Kong's pitch is different.
Hong Kong has the advantage of direct access to mainland China. It is the gateway for Chinese capital going global and for international capital entering China. The Hong Kong Stock Exchange remains the primary listing venue for Chinese companies seeking international capital markets. Hong Kong's assets under management reached over $4.5 trillion in 2024. The territorial tax system, where only income sourced in Hong Kong is taxed, is competitive. And the Wealth for Good initiative, which Hong Kong promotes heavily, positions the city as a hub not just for wealth management, but for philanthropic and impact investment.
But Hong Kong has faced challenges since the political changes of 2020.
That is the elephant in the room. The implementation of the national security law in 2020 and subsequent political changes created uncertainty about Hong Kong's independence as a financial center. Some wealthy families, particularly from mainland China, diversified away from Hong Kong towards Singapore, precisely because they wanted a jurisdiction that is not under direct Chinese government influence. However, the data shows that Hong Kong has recovered significant momentum. The growth from 2,700 to 3,400 family offices between 2023 and 2026 demonstrates that many families still see Hong Kong as valuable, particularly those who want to maintain close business ties with mainland China while having an international platform.
So the two cities are not really competing for the same clients in all cases.
Exactly. And this is the nuance that most analysis misses. Singapore tends to attract families prioritizing asset protection, political neutrality, and diversification away from China risk. Hong Kong tends to attract families that want to maintain and enhance their China connections while accessing international markets. Indian wealthy families are increasingly choosing Singapore for its English-speaking environment, strong legal system modeled on British common law, and emerging position as an Asia technology hub. Southeast Asian families, Indonesian, Thai, Filipino, tend to split between the two based on business relationships and personal preferences.
What about the private banking landscape? Because the banks that serve these families are also adapting.
The Asian private banking market has been reshaped by three forces. First, the Swiss banks, UBS, Credit Suisse, which is now part of UBS, and Julius Baer, have historically dominated Asian wealth management. UBS's acquisition of Credit Suisse created the world's largest wealth manager, and Asia is their fastest-growing region. Second, the Asian banks are challenging them. DBS, OCBC, and Standard Chartered have been aggressively building private banking divisions that cater to Asian clients with local knowledge and relationship depth that Swiss banks cannot match. Third, the rise of independent wealth managers and multifamily offices that offer more customized, less conflicted advice than large banks.
What is the difference between a private bank and a family office in practice?
A private bank is a financial institution that offers wealth management services, investment advisory, lending, custody, and banking to wealthy clients. The bank makes money through fees and commissions, and the relationship is between the client and the bank's team. A family office is owned and controlled by the family itself. It hires its own investment professionals, makes its own allocation decisions, and has no conflicts of interest from selling proprietary products. The trend among the wealthiest Asian families is to move from pure private banking relationships towards establishing their own family offices, using private banks as execution platforms rather than advisory providers.
What kind of investments are these family offices making?
This is where it connects to the broader tech and macro themes we cover. Asian family offices are increasingly allocating to private markets, venture capital, private equity, direct investments in technology companies, and real estate. McKinsey's analysis noted that HNWI families are expected to account for approximately 60% of the $5.8 trillion intergenerational wealth transfer, and these families are disproportionately invested in private markets compared to the broader wealth management industry. The tech connection is direct. Many of the new Asian billionaires made their wealth in technology, and they reinvest through family offices into the next generation of technology companies.
So the family office boom is also a private market capital formation story.
It is a story about how the wealth created by Asia's first technology generation is being recycled into Asia's next technology generation through family offices that operate as permanent capital vehicles. This is structurally different from venture capital, which has defined fund lives and return hurdles. Family office capital is patient, flexible, and often sector-specific because the founding family has deep expertise in the industries where they made their wealth.
Contrarian corner. The consensus is that the Asian wealth boom is unambiguously positive. More wealth, more family offices, more capital flowing into Singapore and Hong Kong, more investment into tech and innovation. What is the skeptical read?
The contrarian position has two parts. First, much of the family office boom in Singapore is regulatory arbitrage rather than genuine wealth creation, and the quality of that capital may be lower than the headline numbers suggest. Second, the intergenerational wealth transfer may destroy more value than it creates because of the shirt sleeves to shirt sleeves problem.
Start with the regulatory arbitrage point.
Singapore's family office numbers have surged, partly because the tax incentive schemes, 13O and 13U, are extremely attractive. A family that sets up a qualifying family office in Singapore can achieve near zero tax on investment income. The minimum thresholds, 15 million for 13O, 37 million for 13U, are relatively low by HNWI standards. This has attracted families that are primarily seeking tax optimization rather than genuine relocation of their economic activities. MAS has been aware of this and has tightened requirements, requiring local hiring, local investment commitments, and substance requirements. But the question remains, how many of the 2,000-plus single-family offices in Singapore are genuine wealth management operations with full teams and active investment programs, and how many are essentially tax structures with minimal substance?
That is a fair question. Is there data on the substance of these family offices?
This is where the data gets murky. Hubis, an Asian wealth management research platform, published analysis noting that the talent shortage in Singapore's wealth management sector is acute, with family offices competing for a limited pool of qualified investment professionals, compliance officers, and administrators. If 2,000 family offices each need a minimum of 5 to 10 staff, that is 10 to 20,000 specialized professionals needed in a city-state with a total population of under 6 million. The talent constraint suggests that a significant portion of these family offices may be operating with minimal staff, raising questions about whether they are genuine operations or largely paper entities.
And the intergenerational transfer concern?
There's a well-known saying in wealth management, shirt sleeves to shirt sleeves in 3 generations. The first generation creates the wealth, the second generation maintains it, the third generation loses it. Research consistently shows that approximately 70% of wealthy families lose their fortune by the second generation and 90% by the third. The $5.8 trillion intergenerational wealth transfer in Asia Pacific between 2023 and 2030 is the largest such transfer in history. And it is happening in families where the wealth creator is often still alive, the governance structures are relatively immature, and the next generation may not have the skills or motivation to manage the assets effectively.
So the bull case assumes the wealth gets transferred successfully, but history suggests most of it will be dissipated.
And here's the part that connects to the financial hub competition. Singapore and Hong Kong are building their entire wealth management ecosystems around the assumption that this wealth will persist and grow. If a significant portion is dissipated through poor governance, family disputes, or generational disengagement, the revenue pool that supports private banks, family offices, legal firms, and the broader financial services ecosystem shrinks. The winners would be the families that invest in proper governance, family constitutions, professional boards, succession planning, and the financial hubs that provide the infrastructure for that governance. The losers would be everyone who assumes the $5.8 trillion transfer is a one-way flow.
The Hubis report mentioned that 85% of India's next-gen HNWIs plan to change their wealth management providers within 1 to 2 years. That is an extraordinarily high number.
It is, and it reveals the instability of the current wealth management relationships. These next-generation clients are digital native, globally educated, and demanding. They want different things from their parents: more transparency, more technology integration, more impact investment options, and less relationship-based old-school private banking. The wealth managers that adapt to these preferences will capture the generational transfer. The ones that do not will lose clients at a rate that undermines their business models.
What about the geopolitical risks? Because a lot of this wealth mobility is driven by Chinese capital seeking safety outside of China.
If China's economy stabilizes and the regulatory environment becomes more predictable, some of the capital that flowed to Singapore and Hong Kong could reverse. Chinese policy shifts, like the unexpected loosening of outbound capital controls or tax reforms that make domestic wealth management more attractive, could significantly slow the family office boom in both cities. The wealth management industry in Singapore and Hong Kong is partially built on Chinese anxiety, and that anxiety is not a permanent condition.
Action items. What should investors and business operators track here?
3 action items. First, track the Singapore and Hong Kong family office approval rates and substance requirements as indicators of whether the boom is sustainable or whether it is a regulatory-driven bubble. AMS publishes periodic updates on family office applications and has been progressively tightening substance requirements: minimum local hiring, minimum Singapore-based investments, and anti-money laundering due diligence. If AMS significantly restricts new approvals or raises the asset thresholds, it signals concern about the quality of incoming capital. Conversely, Hong Kong's revamped capital investment entrance scheme and Wealth for Good initiative show the city is actively competing for the same capital. Watch for any policy changes in either city that shift the competitive balance. A new tax incentive, a relaxed residency requirement, or a tightened compliance standard can redirect billions in capital flows within months.
Second,
Monitor the Indian wealth management market as the highest growth segment in Asia. India's HNWI population grew 5.6% in 2024, with collective wealth up 8.8%, the fastest growth among major Asian markets. India added over 33,000 new millionaires in a single year. And critically, 85% of Indian next-gen HNWIs plan to change wealth management providers, which means the market is not just growing, but actively reshaping. The Indian wealth management market is underpenetrated compared to China. Formal family office structures are still relatively rare in India compared to Hong Kong and Singapore. The opportunity for both local and international wealth managers to capture the Indian market is enormous, but requires understanding Indian-specific preferences around family governance, multi-generational joint family structures, and the cultural dynamics of wealth in India. Watch for DBS, UBS, and the Indian domestic banks, Kotak, HDFC, and IIFL Wealth, competing for this growing client base.
Third,
Focus on the next-generation wealth transition as the defining theme for Asian financial services over the next decade. The $5.8 trillion intergenerational transfer is not one event. It is a continuous process, but the critical variable is whether family governance structures are in place to manage the transfer effectively. Watch for the emergence of family governance advisory as a distinct service category. Firms that help Asian families create constitutions, establish investment committees, plan succession, and manage family dynamics. This is a niche that barely exists in Asia today, but will become essential as the transfer accelerates. Also watch for technology platforms that serve family offices, portfolio management systems, reporting tools, and digital platforms that enable the next generation to manage wealth through the technology interfaces they are comfortable with, rather than the relationship-based models my parents used.
the three signals are family office policy changes in Singapore and Hong Kong as sustainability indicators, the Indian HNWI growth trajectory as the highest growth market, and family governance infrastructure as the emerging service category.
And the big picture insight is that the Asian wealth management revolution is real and massive. The numbers are extraordinary, but the sustainability of the boom depends on three things that are genuinely uncertain. Whether the regulatory-driven family office growth in Singapore has enough substance to persist, whether the intergenerational transfer will be managed well enough to preserve the wealth, and whether the geopolitical drivers of Chinese capital mobility are permanent or temporary. The financial hubs that build for quality rather than quantity will be the long-term winners.
The distinction between attracting wealth and sustaining wealth is really the key tension in this story.
And it is a tension that both Singapore and Hong Kong are navigating in real time. The city that gets the balance right between welcoming capital and ensuring its productive deployment will define Asian finance for the next generation.
And if you want the full written breakdown with the family office comparison, the HNWI data, and the generational transfer analysis, it is in today's newsletter at asiatechmacro.substack.com.
In our next episode, we are looking at the Asian electric vehicle battery wars, specifically how CATL's global expansion, BYD's vertical integration, and the Korean-Japanese alliance between LG, Samsung SDI, and Toyota are creating three competing battery ecosystems that will determine which countries control the most critical component in the clean energy transition.
Batteries are the new oil.
Stay data-driven. Bye.